Thank you, Tom. So good afternoon and welcome to Decarbonising Data. Just some quick facts and figures about Kainos. So we've served over 65 million citizens in a positive way by the services we have delivered since we started in 1986. So about me, I'm head of analytics at Kainos and I've over 20 years experience in this area. I have 3 children. I'm married to Andrew for a very long time and I have a dog called Milo, a big Labrador. I've lived in Northern Ireland for 16 years. So why is action needed? So this talk will aim to summarise the risks facing the banking sector regarding climate change and how data can help banks meet the challenge. According to the European Central Bank's Financial Stability Review, 80% of banks are exposed to climate risk. 2 weeks ago, in a speech given to the ECB-EBRD joint conference, Central Bank board member Frank Elderson stated, "None of the banks under our supervision meet all our expectations. All banks have several blind spots and are already exposed to material climate risk. All banks need to catch up as their climate risk undertakings will eventually influence their supervisory requirements." On top of this, only around 40% of banks have assigned explicit responsibility for managing climate risk to the management body, and of those, 3 and 4 do not report on climate risk to management. In 2019, the Bank of England estimated that up to $20 trillion of assets could be wiped out if the climate emergency is not addressed effectively. To give you an idea of the scale of this, the annual GDP of Japan, the world's 3rd largest economy, is approximately $5 trillion. Banks often claim that their lack of progress in incorporating climate risk into their risk management framework is due to the lack of available data. But in reality, few banks have made any effort at all to take stock of what kind of data they would actually need to start accounting for climate risk. All banks are expected to harness the information that is available on climate risk and to start assessing the materiality of the risks that they are facing. There are risks to acting on the basis of partial data, but in the case of climate change, the risks of inaction are far greater. Whilst responding to climate change has traditionally been seen as the realm of government policy, there is growing recognition that the financial system has an important role to play in managing climate change-related risk. In his Mansion House speak this very week, Rishi Sunak has announced new rules called the Integrated Sustainability Disclosure Requirements. These will be mainly targeted at financial services firms and will require firms to say what risks and opportunities they are facing from climate change. However, it's not all bleak. By harnessing data, AI and machine learning, there are significant opportunities for growth and development of climate-smart finance as society and the economy move to both being low carbon and more resilient to a changing climate. So to illustrate the risks that banks are facing, we'll look at the UK mortgage market as an example. In England, 1 in 6 properties, that's around 5.2 million properties, are at risk of flooding from rivers or the sea, 1 million of which are also at risk of surface water flooding. A further 2.8 million properties are susceptible to surface water flooding alone, and 25% of those occur in areas not formally recognised as being flood-prone. And add to that 6 million homes in the UK do not have any form of home insurance. And it's not just flood. Increased temperatures will put millions of homes at risk of subsidence. Data from the British Geological Survey shows that approximately 1 million homes were at risk in 1990. This will rise to 2.4 million in 2030 and up to 4 million in 2070. When you consider the outstanding value of all residential mortgage loans in the UK at the end of the first quarter this year was £1,562 billion, just looking at mortgages alone illustrates the challenge of climate change to the banking sector. The data to give a full picture of this comes from multiple sources, for example, energy performance ratings, flood and subsidence models, asset data. As yet, many banks have not fully harnessed the power of this data, AI and machine learning, to help them meet this challenge. By bringing this data together, banks can use AI and machine learning to give them a full picture of their mortgage exposure, automate the population of energy performance ratings into their systems, factor flood and subsidence risk into their lending and underwriting models, and ensure that climate risk is accurately reflected in their ICAP. It also brings a host of byproducts and other benefits. As well as allowing banks to understand their risk, harnessing their data also provides them with great possibilities and potential. Climate change offers financial institutions numerous business opportunities and is expected to generate $2.1 trillion worth of opportunity. A recent survey carried out by YouGov across 24 countries showed that 85% of adults state that they're willing to take personal action to combat environmental and sustainability issues this year. Banks are uniquely placed to influence this consumer behaviour, given their important role in society and the daily interactions they have with people through their current accounts. As of January 2021, 76% of UK citizens use their online and mobile banking at least twice a week. Individuals can monitor their carbon emissions with the same diligence as progressive businesses already do today, all the while receiving intelligent suggestions as to how they can change their behaviour for the better. The effects of innovations like these will ripple through the economy as retail spend from carbon-conscious customers shifts towards less harmful options and businesses can adjust to that change in demand. This presents a unique opportunity for banks to leverage the power of their transaction data to help both personal and corporate customers understand their carbon footprint and surface options to help them meaningfully reduce their impact. Unlocking this capacity requires a comprehensive approach to assess the impacts of different types of behaviour and accurately match those with customer transactions. Firms like Klarna and MasterCard are already offering this to their customers using the independently verified Ireland Index blended with global merchant category codes and customer transaction data. Banks are blessed with phenomenally rich data sets that can make all this possible. New products and offers could be linked to this data using AI and machine learning in real time to analyse customer accounts and behaviour. For example, a customer might set themselves a carbon target and be rewarded for meeting this target or offered tailored suggestions as to how to reduce their carbon footprint. We're already seeing some banks offering green mortgages, and these are typically offered on properties with an A to C performance rating. However, if banks could incorporate EPC data, this could be automatically offered at the time of lending using AI as part of the application process. This would save the customer time and effort in having to look for energy performance certificates themselves and allow banks to be proactive. Attracting more mortgages of this type will also lessen the increased exposure risk associated with properties with a rating of D to G. Add in the flooding and subsidence data, and banks can have a real-time view of any assets that they are lending against. Other new products, such as loans that charge lower interest rate to corporate borrowers who meet or outperform sustainability targets, are a powerful incentive and can create new business, lower credit risk, and support the real economy's transition to lower carbon activity. So what are the challenges? So many banks, however, have struggled to move from experimenting around selected use cases to scaling AI and machine learning technologies across their organisation. The reasons tend to fall into two categories, the practical and the strategic. So the data. The data is often siloed and not of the best quality. There are areas where data limitations are an issue and work is needed to overcome some of these limitations. The data challenge may pose an opportunity for those banks that are able to move more quickly in this area. And also, as more regulators get involved and set firm expectations on climate-related disclosure, we should see banks continuing to develop data-driven ways to meet regulatory expectations. We need to see more use of open data and external data, for example, our energy performance ratings, weather data, climate models, and asset data are required. There needs to be a greater investment in skills. Data needs to become part of everyone's job in the same way that IT is embedded today into every area of a bank. Banks can augment this with external support whilst having a plan to upskill their own people. There are obvious concerns about data privacy and security, but this has led to an overly risk-averse approach in banks, e.g. a low use of cloud technologies and not updating marketing and profiling preferences to deliver these insights to customers. The volumes of data are challenging to work with without these skills and infrastructure being in place. And again, the technologies, there's legacy systems, older technologies, and again, that slow adoption of public cloud means that the value in the data is not able to be fully realized. Banks also face business and strategic challenges with harnessing data and AI to meet these challenges described. These need to be resolved in order for them to meet the climate change need. McKinsey interviewed executives at 13 global and regional banks based in 10 countries across Europe and the Middle East and found them all struggling in the following areas. Banks are not quantifying the potential of analytics at a detailed level. They are not engaging business leaders early and developing models that are really solving business problems and that business leaders will trust and will use. They fall into the pilot trap, continually trying new experiments, but not following through by fully industrializing and adopting these. They're investing too much upfront in data infrastructure and data quality without a clear view of the planned use or the expected returns. They are not seeking cooperation from businesses that are protecting rather than sharing their data, and they undershoot the potential. Some banks just put a technical infrastructure in place, throw some data scientists at it, and are executing analytics on a tactical project-by-project basis. They're not asking the right questions, so algorithms are not delivering actionable insights. Harnessing data to meet climate change will help banks manage and understand the risks and the opportunities, as well as giving banks a useful, structured and strategic project on which to begin their data, AI and machine learning journey. I will leave the final word to Sarah Breeden, the Bank of England's executive sponsor for work on climate change. She says, integrating climate and environmental data and analytics into decision-making will allow financial institutions to identify, measure and manage the financial risks and opportunities from climate change, and so support the objective to ensure the financial system is resilient to these risks and supportive of the transition to net zero. Thank you so much for listening and enjoy the rest of your conference.